A very warm welcome to all our valued customers who have joined us today from across the world. My name is Deepa Thakkar and I manage NRI products for HSBC India. I will be your host for the evening and I am delighted to welcome you today to our special initiative Life Beyond Borders. Today's webinar is on mastering the mind, exploring behavioral biases in decision making. As we navigate the ever changing global landscape, making sound investment decisions can be challenging. From upcoming elections in European countries, the United States of America, to the global geopolitical events around the world. These factors can significantly impact the markets and, more importantly, investor behavior. Historically, markets have exhibited interesting trends before and after elections globally. While there is no single rule book, some patterns like pre election volatility, muted election day responses, or varying post election performances are common. However, historical trends are just one piece of the puzzle. Your own internal biases can also influence how you react to these events. This webinar aims to empower you, the investor, to understand how these external factors and your own internal biases, like holding, anchoring, can cloud your judgment and lead to a suboptimal investment decisions. I'm pleased to welcome my colleague Rajat Handa, head and group distribution and central initiatives at HSBC Asset Management India. He has been with HSBC Group for 24 years, having worked across the bank and asset management company in various domestic and international locations. In his current role, he leads the group distribution channel management, heads the portfolio management business, and spearheads the learning and development vertical for HSBC mutual funds. He is a graduate in science from Delhi University and holds a postgraduate qualification in business management from Institute of Management Technology. A very warm welcome, Rajat. Thank you so much for taking out time today and guide us through the world of behavioral biases and equip us with the valuable remedies to overcome them. Audiences, please do keep sharing your questions and comments, and I will take it up with Rajat. We will try and answer as many questions as we can. Without further ado, welcoming Rajat to take over the floor and share his insight.
Thank you, Deepa. Good evening to you, and good evening, good afternoon, good morning to all our dear clients and investors who've logged in from across the world. A lot of things are happening. Deepa, you mentioned about elections and geopolitics. Let's not forget the cricket tournament, which is happening for the first time in the United States. Let's not forget the rains which are happening in Mumbai, where you and I are currently stationed. And all these things do impact human behavior, right? So it's a very apt moment to talk about various changes and various dynamics that are impacting human behavior. We usually interact with our clients on matters related to markets, matters related to investments, matters related to asset allocation and portfolio construction. But I would like to thank you, Deepa, for taking this initiative and talking a little bit about the mind, which matters more than the money, right? Because ultimately it's mind over money and not the other way around. So this session, ladies and gentlemen, and thanks for joining in from all over the world once again. This session is a departure from usually what we do when we mention investments and finance and financial planning and personal financial wellness. This is a kind of an insight into our own minds. So, what clicks when there is a certain reaction in the markets? What makes us do what we should do, or what makes us do many times what we should not do? So, this is probably you would feel that on a Friday evening, and it is evening in Mumbai. We are deep, we are probably diving into psychology. But let me tell you, I have been a student of behavioral economics for the last 10, 15 years, and it is a very, very intriguing and an exciting topic. So, today we will talk about behavioral biases. We will talk about those instances, those triggers, those natural human reactions, the way we are wired, which actually impact our decision making when it comes to taking very important financial and investing decisions. I promise you, this is not going to be a theory class. We will also have a lot of practical, real life investment market related examples. just to exemplify and illustrate how the investment behavior is impacted and how this entire machinery works. So this is what we plan to talk. I think Deepa, I will take this for another 30 minutes or so, and we will give ample time for our investors to type in their questions in the Q&A and the chat boxes. And then I would request Deepa to do all the hard work and collate them and ask them to me, put them forward to me. Okay. So behavioral biases. Before I change the slides and show you a little bit and talk to you a little bit about biases, let me share with you a very interesting phenomena. And the phenomena is that, and this is an interesting statement and probably food for thought for a lot of you over the weekend. The portfolio returns, and all of you are investors. Some of you would have invested in Indian mutual funds. Some of you have invested in unit trusts across the world. A lot of times, the portfolio returns are decided not by the portfolio manager, but by the investor's behavior. I just pause here for some effect and for some introspection. Yeah. So we have to, a lot of times we blame our portfolio managers and fund managers and advisors for not giving the right returns. But ultimately, for any long-term portfolio, it's more to do with what decisions I as an investor or Deepa as an investor or you as investors take, at what point of time you take those decisions and how frequently you take those decisions that decides that what is the kind of returns that you will end up with in your portfolio. Now, with that thought provoking statement, let me share with you some slides. So, when we talk about biases, what is a bias? So, bias, we all understand, somebody is biased against this, somebody is biased against that. But in true finance, philosophical, psychological parlance, bias is typically an irrational preference or a prejudice held by an investor, an individual, which may not be very apparent, which may be also intrinsic or subconscious. So when I say this, I'm telling you, although I'm taking this masterclass 101 on behavioral finance and economics, but I myself am guilty of being prejudiced with respect to a lot of investing biases or behavioral biases. We are all human beings, and all human beings suffer from two kinds of biases. There is something called an emotional bias, which is basically a fight or flight, a binary, either yes or no. And a lot of times these are called knee jerk reactions. And then there are those deep rooted, deep seated, as they said, subconscious cognitive biases. We call them cognitive biases. And all of us are hardwired in a certain way that we can't escape those biases. So what I'm trying to tell you right now is that there's no way out of this. It's all natural and it's all fine to be prejudiced in a certain manner because it's all human nature. Then what is the point of this session? And Deepa, I'm sure you'll be thinking about it. How do we help our investors overcome these natural subconscious cognitive biases? So I'll try to give you some solutions around it. I myself am a student. I'm trying to learn to grapple with all these biases, and I hope I can make this experiential learning and sharing session an interesting one. So, biases, when it comes to investing, I think biases can work not in your favor in a couple of ways. One, obviously, you can fail to take rational investment decisions if you are biased, if you are prejudiced, if you think in a particular manner, and you're not open to other thoughts of other schools of thought. Or it can also be biased in a way you consider your investment risk. Yeah, so you can be biased in the way that you feel about a certain product or an opportunity and its risk factor. So it can have a deep impact on the risk perception. How do you perceive the risk which a particular investment or a portfolio carries? And many times losses in the portfolio are caused because of these biases. Yeah, so it is a very important part of economics. It's a very important part of personal wealth management. And I think the session today is more about you and me being cognizant and aware of the fact that these biases exist, in the hope that maybe in next time when you see the Sensex fall or the Nifty, go berserk on the upwards, you will react in a way which is scientific and less imaginative and biased or cognitive. Okay. So let's talk about some of them. I was just mentioning to Deepa before this session started, appreciate the very enthusiastic response which we are getting on this webinar. I was sharing with Deepa, these questions were coming in even before we started, that there are more than 180 cognitive biases which are present in the world of psychology and investing behavior. So obviously, because of paucity of time, limitation of time, it's not humanly possible to cover all of them. So what we have done today, we have picked up seven very critical, very significant, top of the mind biases, which usually impact a lot of times the way we take decisions. So I'll take you through all of them. There are seven of them on the screen. I'll spell it out for you. We are talking about herding. We will talk about overconfidence. Anchoring is a very interesting one, and I'll give you some practical examples which you can relate to. Mental accounting, we do it all the time. Yeah. Regret avoidance, and I'll give you some examples beyond investing also when it comes to regret avoidance, availability bias, and confirmation bias. So there are common threads running across all these biases, and it's a very interesting story and a very interesting yarn which we would try to knit for the next 20-25 minutes. Okay, so let's start with the first one, herding behavior. Deepa, I think all of us would have read the fairy tale Pied Piper of Hamelin, right? So if I can, to probably ruffle some feathers and memories, you would remember that there was this gentleman who actually took the rats, off the cliff. Yeah, and this is probably one such clip from that story. Now, if Pied Piper can do it today, ladies and gentlemen, there are lots of Pied Pipers in the world. There are lots of people who actually claim to be authoritarians, who claim to be experts, and they have a voice. And thanks to social media, thanks to all the superflow of information which all of us can access, this has become a problem. So herding is nothing but people blindly following people on the assumption that they find safety in numbers. So if you find 100 people doing something, you would blindly do that. Yeah. If I find 10 people, buying a particular stock or a company, I would say there would be something right, because 10 people, the collective intelligence of 10 people, 20 people, 30 people would be much, much more than one single poor little individual like me. Okay. So this is a very interesting bias. It is an interesting behavior because a lot of times we have seen that this happens. I'll give you instances in the past when it has happened. Let's go back to 1998, 1999. Yeah, I had just started my career then in banking and financial services, and I recall that there was a huge following, fan following of everything which ended with the word .com. Yeah, so anything .com would probably IPO in the US or in Europe or in Hong Kong and Singapore, and would fetch a very obnoxiously high premium. Yeah, so that was one example of herd behavior or herding. Then again, it is not just one crisis that gives us meaning. There was a financial crisis, the GFC, the global financial crisis of 2008, when all the banks, all the lenders to mortgages, all the companies who were issuing bonds against mortgages in the US and in Europe, there was a big craze for those kind of assets because they were all giving you phenomenal returns, right? And if my neighbor, my friend, my colleagues, they're all buying it, then why should I miss out? So that FOMO factor, the fear of missing out, was playing a big deal in this. And this is what happens in herding. So how do you avoid the herding behavior? I usually follow Warren Buffett in a lot of things. And Warren has said that very famous and very cliched now. And this quote is, when the world is greedy, be fearful. And when the world is fearful, be greedy. So don't go by the world. Don't go with the tide. Think individually and then decide. Yeah. Think about a very practical situation. Deepa, I think it will have happened to you. It has definitely happened to me. Whenever I go to any a new country which I have not visited earlier, you usually go through Lonely Planet or TripAdvisor and check out all the nice places, right? So I did that. Gone to UK a few months back, and I actually studied some of the good restaurants which were serving authentic Indian food. I did my research, a good amount of time, and I actually went and visited that restaurant. Now, unfortunately, there were only two people in that restaurant at that point of time. One was me, and the other one was a restaurant manager. Okay. It was a Michelin star restaurant. It was very highly rated. There were oodles and oodles of comments in favor of that restaurant. But I decided not to visit because there was another restaurant which was hustling and bustling in the neighborhood with almost 25 or 30 odd people. So I chose to go there. So again, trying to tell you that I found comfort in numbers, right? In spite of the fact that I had done my research and maybe what I actually ended up eating was inferior to what I would have done had I visited my own, or I would have validated my own research. Yeah. So Couple of ways you can avoid this. One, question yourself. You can also play as a devil's advocate at times. Uh, Try to steer clear from the herd and maintain your own independence when it comes to deciding, because what fits your neighbor may not and probably will not ever fit you. So I think this is a very important point which I wanted to make. And a lot of decisions, Deepa, we make when our friend or relative or neighbor has bought or sold that particular company. Yeah. Let's come to the next one. And this is overconfidence. Overconfidence, I think, impacts us in all aspects of life, not only investing, but during our careers, our relationships, everywhere. So it is actually, in a very simple way, if I have to describe it, it's a tendency to exaggerate, to overestimate your ability to perform a given task. Okay. Now, how does it impact you when it comes to investing? So, there are people who are self proclaimed authoritarians and experts, and they would say that, we have got it right. We sold our stocks before the markets crashed, and we bought the stocks, when the markets were low. Yeah, you would have probably come across a lot of such people who claim to be experts. I would say they are more less of financial experts and more of astrology experts, because this only astrologers can guess, or maybe they can't. So that's on a lighter note. But this overconfidence is a big plague and a big detriment when it comes to investment planning, because you're not able to decide rationally on the basis of facts and data whether a decision needs to be taken. Now, with a stroke of luck, an investor may be proven right. You may actually invest in India or in any equity market before you actually sell before March of 2020. Why I'm saying March of 2020, I think all of you can relate to that. That was the sharpest fall in global markets because of the onset of COVID. So you may get lucky once. You can probably exit your portfolio, but who would have told you that within 3 or 4 months the entire market would have come back ferociously and beaten and surpassed its previous high? Yeah, because at that point of time, Deepa, ladies and gentlemen, we did not have a clue that you would have not one but maybe 7 or 8 vaccines which would help in opening up the world, right? So doomsday scenario did not play out, and within a couple of months, 3 or 4 months, the market started coming back. So you can get it once, but you can't tom about the fact that you are an overconfident guy and you or girl and you are going to be right all the time. So this is also something which need to be focused on. How do you avoid this? I think every professional, including me, who's a part of a fund management house, should acknowledge the fact that nobody is God. Nobody has the gift of prophesying or looking into a crystal ball. Every professional fund manager and trader can struggle to achieve a market beating consistent strategy. Okay. And those of us who actually maintain realistic expectation and estimations, they know that every investment day you can have a big sell off. You can go contrary to the things, can go contrary to your choices, or you can end up smiling your way to the bank at the end of the day. So keeping your expectations realistic, understanding and making yourself aware that even fund managers and investment gurus can get it wrong, is this thing, and is a way of bypassing overconfidence. Also, the last line is very interesting here. Overconfidence investors are only a trade away from a very humbling wake up call. Yeah. So please beware of this bias. It can come to your head, it can sit on your head and decide what you should buy and what you should not. And I think you should keep it very, very sane and logical. Okay. This is, I think, one of my favorite biases. And Deepa, I think you can also relate to this. Uh, we all know what an anchor is, right? The ship's anchor. Yeah, ship drops an anchor so that it can tie itself to the shore, and there is a reference point. So when we talk about anchoring in investing, we are talking about your fixation to a particular point or a particular situation in the past. Now that past can be recent or it can be distant. Yeah, there's nothing wrong in it. We are all fixated to something which has happened in the past, either in our lives or in our careers or in our portfolios or in markets. Like I just talked to you about the COVID factor, right? So maybe, who knows, maybe I am having an anchoring bias towards that point in our lives when COVID struck and markets crashed. But what is not so right is sticking on to that and using that as a constant continuous reference point for all the decisions that you make in future. That is damaging. Yeah, I'll give you some examples. Let's talk about the Sensex. We have overseas investors, we have Indian investors. I think everybody is familiar with the Bombay Stock Exchange BSE Sensex, and we all look at that as a barometer or a kind of a wind vane for the markets in India. Now, what direction the markets are. Now, there can be an investor who will always and always remember that the Sensex in the fall of 2008, which was one of the most devastating market crashes in the world, the in end of 2008, the Sensex fell from a number of 30,000 or 28,000 to a number of probably 8,000 or 9,000. Memory is defeating me right now, but there was a big fall. The fall was almost from 21,000, I got it right now, to 8,000. Yeah, 60% of the wealth was depleted. Now, there were a lot of investors who took 21,000 as a reference point, Deepa. And all their investment decisions were that unless I get back to 21,000, I'm not going to invest because I had my investments at 21,000. I had a bad time after. Yeah. Think about all those investors who did not invest in the time at the time when the market started coming back from 8,000 point, the Sensex, to 21,000. And let me refresh your memories. It did not take 10 years or 5 years for that to happen. It actually happened in less than a year. Yeah. So at times, because of our biases, because of the anchoring impact, we continue holding on to a reference point. I bought XYZ stock at 1500 rupees. Today it is at 750. I will not sell it or I will not buy it unless it comes back to my reference point, which is 1500. Who knows, and who is there to tell you that 1500 is a price which may never come back? Maybe 1500 was a bloated or an inflated price. So the intrinsic value of the stock gets kind of sugar coated or curtained because of the anchoring bias. This is one of a very difficult biases to deal with because it's human psychology. We all kind of anchor ourselves to a reference point, be it a birthday or the day the markets crashed, and it becomes a challenge. How do you avoid this, Deepa? One, you need to engage in rigorous critical thinking, data, statistics, rational, talk to people, play devil's advocate, all these things. So when you question yourself, when you deliberate inside your mind, then maybe the anchoring bias goes off. Also, I think it's best to be careful about the data you utilize to evaluate the potential of the investment. There's a very popular saying in financial world which we always used to, that you can twist data to prove anything. Yeah, you can twist data, you can torture data, and data will speak your lingo and speak your language. So please be careful on what kind of data you're relying on to save yourself from the anchoring bias. And again, the last point: never base your decision on just one or two reference points or benchmarks. Yeah, just because you've got two prices of a stock, what you bought at and what you sold at, doesn't mean that you have to ignore or you should ignore all the other fluctuations which have happened in the life of that company since a time immemorial. Yeah, so I think you need to broaden your data perspective, and I think it is a more of practice to get rid of this anchoring bias. Okay, three more to go. Mental accounting. This is not so much of investing, and I think more and more people will be able to relate to this, even those who are probably finding this a little more technical and psychological. Let's talk about how do I make or how do I manage my budget. Yeah, so all the home managers who are there on the call from all across the world, you have your financial balance sheet at home. How do you manage your income? How do you manage your expenses? So what usually as human beings, as human behavior, what we exhibit is that we kind of have this uncanny habit of bucketing our assets or liabilities. We bucket them. Yeah, and I'll explain this to you with a very interesting, with a very common example. I may have a loan running, which may run into hundreds of thousands of dollars or maybe crores of rupees. So I have a liability, right? And I have to take care of that liability because taking care of your debt and liability is probably one of the most important and significant priorities of any individual. So I have a loan running. I want to keep it separately in a jar. Just visualize that I'm keeping my home loan, a mortgage, in a jar. And I have a savings account or a wealth account or an investment account running parallelly where I'm investing money. So what I'm saying is that I am making money because I am making well, but I'm not looking at my liability, which is there. So money is fungible. What one needs to do is take into account the holistic picture. You can't keep spending and spending and spending because you're earning a lot of money when you have credit card debt which has not been paid or serviced for the last 6 months. This is exactly what mental accounting does. You differentiate and deliberately try to segregate one liability from the asset and say, okay, on the right hand side, I'm doing very well. On the left hand side, I'm not doing so well. Ultimately, the left and the right combine, and your entire financial picture looks very gloomy. Yeah, so this is mental accounting. As I said, this is not so much to do with investing, but I think some as I mentioned to you, credit card debt, this is an example which is coming up here. Some important tips or probably, kind of experiences which we can share is that money is fungible regardless of what is the end use of this money. You need to take care of money from an overall perspective. Also, as I said, it is more rational to forego some of the savings, some of the expenses, and some of the investments in order to pay off your debt. Because debt also compounds the way your investments and your savings compound. Please remember that. Okay. So that's a little bit about mental accounting. What do we have next? We have some other biases, which I'll try to cover quickly. And then, Deepa, we can take some questions after this. All right. Okay. So, regret avoidance. We all have regrets. That's a good thing. But is it good to avoid those regrets? Is it good to sweep those their regrets under the carpet? Maybe not a great idea. And again, a very simple and a common example from life. Deepa, you can probably relate that to a dress or some gadget which you purchased recently. I will probably blame it on a car that I bought a few years back. So everybody can make a mistake in a decision. You can buy something wrong. Maybe your research is not backed up properly. Maybe you are a victim of herd mentality, which we saw in the beginning, the herding behavior, and I bought a bad car. Now that's a regret. What I do to make things worse is that I keep on spending money to decorate it, to repair it, and the original cost of the car blooms up and goes berserk. So this is one way of showing to you in a very colloquial manner that to cover one bad investment decision, a lot of investors make multiple such decisions. A stock is falling, they say you should never try to catch a falling knife, right? This is very true for investments. A stock is falling, it's falling every day, it is falling. Some smart aleck comes up and says that I want to invest at every fall, at every 10%, every 20%. I'm very, very satisfied and very happy for that investor as long as there is solid research backed at the fact that it is good to invest in this stock because the future is bright. But what usually happens is that, again, because of the previous biases that we talked about, anchoring and herding, you try to invest at every fall. And to cover up one mistake that you picked up a bad company, you keep investing more and more in that portfolio in that company. So I think one should stay away from this. Have a regret. Be aware of the fact that you made a mistake. Everybody makes mistakes, and then move on. Yeah, move on to the next best idea. That's what Charlie Munger used to do, associate for Warren Buffett. That's what a lot of good investment managers say, that if we have made a mistake, don't brood over it, move on. There are more stock ideas than people on this planet in a jocular way. So there's no dearth of ideas and dearth of opportunities. Okay. One interesting one to Deepa, which I think our Indian investors can relate to, is the tax saving plans. So everybody knows that there are instruments in India which you can do, which you can invest in to save taxes under various sections, right? ATC, etc., etc., ATD, and all that. Now, irrespective of your objective, irrespective of your goal, you will go and purchase a tax saving instrument in March. You may not even have a tax liability. You may not even need that instrument because you're already completely covered under that tax exemption. But still, because it is a tax saving season, because you're hearing about tax saving everywhere, you would go and invest. Now, this is an example of availability bias. You know why? Because so much of advice is available, because so much of information is available nowadays. So, this super information highway, which we call, or the overflow of information, is a big devil and a big problem to handle. It's not a good problem to have. I find it's a very bad problem. It's a very ugly problem to have, because at times a lot of us, including me, including I'm sure a lot of you, I'm sorry to assume things, but we all tend to throw a lot of weight on information which is readily available, unsubscribed reports, free reports, CNBC, Money Control, all the flashy channels which come up with tickers and news breaks and breaking news, which kind of disturb our night's sleep and whatever we're doing in the day. So this becomes a huge issue. And just because the information is available, I will go and buy gold. Just because information is available, I will go and invest in crypto. Crypto. Yeah, we'll talk about that. So I think availability bias is also something which needs to be tackled. Information which is readily available needs to be seen and viewed with a pinch of salt. One also needs to look deeper, understand what you want from your goals, from your life, and from your risk taking capacity, and then seek for the right information. Even if it is not available, please do not hesitate in reaching out to the experts who have that information available. Okay. And we come to the final one, which is confirmation bias. And this is, you will say that probably I can tell you that children at home, when we observe children in the way they behave, I see that a lot in them, and I was very surprised and a little bit embarrassed to know that even us adults, mature adults, also suffer from a confirmation bias, and I'll tell you how. So what is a confirmation bias? You are stuck to a particular belief or a thought in life, in finance, in career, and you will turn the world upside down to prove yourself right. You will harp upon the fact that whatever I said at that fateful hour or that fateful day, I was right and everybody else was wrong. And you will try to corroborate that by finding out all kinds of positive and reinforcing news items and arguments, positive arguments in your favor to prove that. Now, just copy paste that, ladies and gentlemen, and apply that to the field of investing. Okay. So you bought a stock of a particular automaker. Just giving you a reference. I'm very positive in auto, so please don't read this as any kind of advice I'm giving. You bought a stock of a particular automaker in India or in the US, and the stock is not performing well. Yeah. So a lot of research which you put in, and 6 months, 9 months, that the stock is underperforming peers, it's underperforming competition, it's underperforming the benchmark. What do? If you are a victim of the confirmation bias, you will Google, you will scrape through and search through and shift through all the newspapers which are available. You will call up your friends and you will keep piling up oodles and oodles of data to confirm that the stock is going to bounce back. Trust me, Deepa, everybody has an opinion, right? And you will always find 100 points and arguments in favor of your argument. It's like an elocution, right? And you will find almost 200 points against your argument, not in favor of your argument. So you will ignore all of them, which tell you that the stock is bad and you should get rid of it. You will hang on and stick on, and you will probably wax eloquent on the arguments which tell you that you have made the right decision. The stock is going to bounce back. This is a classic case of confirmation bias. How do you overcome this? Please be open, be rational as an investor, seek contrary advice. I would love to meet people who differ. Yeah, I would love to have people, and talk to people who say that I have a different view and I have an opposing view, because that actually tells me that, there is a buyer and there is a seller in the market. Because the person who does not agree with my purchase is actually a seller. And this is how markets prosper. This is how information spreads. And it helps you to make a neutral, unbiased decision. Yeah. So these are all the biases, some of them which I wanted to cover. Uh, and just to kind of summarize on the remedies, although I did speak about individual biases and how do you overcome individual biases. But if you ask me as a general thumb rule, again, heuristics, thumb rules, right? They're also bias. Just because you are above 75, you should not invest too much into equity. Now this used to be true 30 years, 40 years, 50 years back. Today you ask the septuagenarians, the octogenarians, and they'll tell you the other way around. They'll say, our risk appetite has gone up thanks to the positive experience that you've had in equity. So please do not go by the old jaded thumb rules and heuristics. uh, you should periodically review your investments and your risk profile. Like I mentioned, the risk profile keeps changing at different stages of your life. So kindly review your investment and risk profile on a periodic basis. You will stay off from most of these biases if you do that. Data is very important, genuine data, realistic data, authentic data with credibility and credentials. Please refer to that before you kind of make any decision. And the last 2 points, which HSBC as an organization stands for, our wealth management business is based on these two foundations. We believe that goal based investing is probably a cornerstone for your financial planning. So if you have to start with financial planning, if you have to start with taking investing decisions, you need to first get this in order. So plan your goals, and all the decisions that you take should be in accordance to and in line with the goals as and when they mature. And let's not forget the magical two-word phrase at the bottom: asset allocation. 94%, almost 94% of the returns in any portfolio are usually attributed to asset allocation. It's not your timing, it's not your security that you bought or sold at the right time, it's not the research that you did. It's all about having the right money in the right asset, in the right proportion, at the right time. This is asset allocation. Yeah, I'm not cooking up numbers. This 94% is a Nobel Prize winning study done by a team of financial specialists, Brenson and team, and they won this award many, many years back. So if you stick to asset allocation and if you focus on goal based investing, most of these biases, I think you can completely stay away from. So I think Deepa has spoken enough, a lot of psychology and finance in my discourse, and I'll open it up to you for questions now.
Thank you so much, Rajat. This was very insightful and many things which most of us would not know. So clearly, you are a great student of psychology, I must say. And there are some questions that we've got from customers, some statements also some clients have given to add or reiterate what you're saying. So you did mention that to avoid these biases, we should stick to the asset allocation, right? So according to you, what is the right approach of asset allocation? Because we have a lot of young customers also who are listening us today. So what do you suggest to them, the right approach for asset allocations?
Yeah. So asset allocation, and that's a good practical question to ask after all the psychology and theory, Deepa. So I think asset allocation is not probably the first step that you need to take when you embark upon this journey of financial wellness and planning. And since you mentioned young investors, India is one of the youngest countries. We all know our median age is less than 30. So if you consider the entire financial planning journey, the first step is goals. I would say that let's not put the cart before the horse. What I'm trying to tell you is that if you get your goals right, if you're able to quantify your goals, if you're able to kind of put them in certain time and duration buckets, then asset allocation will kind of make the job easier. And the goal part is an art, and asset allocation is a science, and investing is all about art and science, right? So first, let's get the art right. I would suggest and I would advise all the young investors on this call to quantify their goals, put them into various time buckets. Also, very important, look at your time horizon, look at your liquidity needs, and important, very important, your risk appetite. I may have a risk appetite where I don't lose on to my ECG if the markets fall by 5 or 10% on a particular day, which, as a matter of fact, they did about 10 days back, right? You know what happened on election day or the day before, Deepa, in India. But you may have a completely different risk profile. You may be somebody who would, probably lose sleep even if your portfolio is down 0.5% on a single day. So everybody is wired differently. Again, cliche, one size does not fit all. Yeah. Everybody is an individual, everybody, and you need to understand yourself. So asset allocation will be an outcome of all these three or four processes, starting with goal identification, risk tolerance assessment, uh, you know, putting your goals in time back buckets and looking at your liquidity. And then if you have a goal which comes in later in life, for that you can asset allocate in a high risk high return instrument. If you have a goal which comes in sooner, which means maybe 6 months or 1 year, then that kind of an asset, that kind of a requirement cannot be fulfilled by putting money into equities, because equities can lose money in the short term. Equities do very well if you hold on for 5-10 years. Yeah. So that bucket of money where you would probably need in the next 6 months or 1 year or 2 years should go into something which is outside of equity. Talk fixed income, talk gold, talk bonds, talk deposits. I mean, we're not here to give advice, but I'm just giving you the kind of options which are there in the world. Yeah. So everybody to each to his or her own. Asset allocation comes in later, and it's an outcome of a lot of things that you do initially.
Thanks, Rajat. The next question is, while you have told us in the start itself there is no right time to buy or sell, but still, people are asking, is there a right time to buy or sell investments?
Okay. Yeah. I think investors will always ask this. At times, I'll not lie, Deepa, even I ask myself, is it the right time to invest when you see the market going crazy, either this way or that way? So I'll give you a kind of a rhetorical answer to this. Yeah, the rhetorical answer is that when is the right time to buy? And I'm assuming that you're talking about equity markets, right? So when is the right time to buy in the markets? The answer is when you have the funds. When is the right time to sell? The answer is, and Deepa, I'm sure you're guessing it, when you need the funds. So it's too simplistic. I know I'm trying to oversimplify things. It's the real life and practical life doesn't go by that, but the basic principles and the very colloquial statement that I made to answer this question, at the risk of making it sound oversimplified, are the same. The basic principles of deciding when to buy and when to sell are the same. You have surplus funds, you have a goal, or you don't have a goal and you just have surplus funds, deploy the money. Don't think about whether the market is at X or the market is at X minus Y or the market is at X plus Y. Similarly, when you need the funds, or when you think that your goal has arrived. For example, there are a lot of people in India who seek retirement advice from us, right, Deepa? We have a lot of investors across the world, not only in India, who are probably reaching their golden years. They've touched 60, or they're touching 65 or 70, and they want to retire. In fact, nowadays we have people who are retiring at 39 and 40 also. That's your new economy. And a lot of them at times ask us about the fact that, when should I sell? So my advice to a lot of those investors have been, and this has been all over the years when I've been engaging with investors, that if you think that you are retiring and you don't have a steady source of income which will dry up in the next maybe 1 year or 2 year, then start gradually withdrawing your money from equity or high risk assets in a gradual manner, and start decreasing your exposure to high risk assets, because that money will now need to go into something which is giving you a steady income, which will replace your employment generated income and substitute it with investment generated income. Yeah. So that's when you sell. Or if you need a house, if you have a marriage coming up with the family, if you want your child to have quality education, college, all those goals, then is the time to withdraw. Just because just because you have made a 30% return in 1 year does not mean that you should sell. Just because the market has fallen by about 15%, 20% does not mean that you should take a loan and buy. I hope this is useful.
Yes, yes, absolutely. This covers and this gives us a glide path. The next question is, how do we eliminate imposter syndrome while making decisions?
Okay. So, Deepa, I had given you a caveat in the beginning that I am not a doctorate in psychology. I may be acting or pretending like one, but I'm definitely not. I'm a student. I study, and I'm very passionate about behavioral finance. So, there are more than 180 cognitive biases, which only probably, PhDs and postgraduates in psychology will be able to understand and answer. A lot of them I will not know. This one, imposter, is something which is recent, and the application of this bias is more contemporary. So maybe I can share my views on that, right? I may not be 100% right. So whoever's asking this question, apologies if you have a different view or understanding. Imposter view, according to me, is the opposite of overconfidence. So, Deepa, in overconfidence, we said that, I am completely convinced that I am God, and I, as a fund manager or a portfolio manager or as an investor, I'm taking the right call. I have the right knowledge. I am taking the right decisions. I don't want to listen to any contrary view. Yeah. The imposter view is the complete opposite. It's a mirror image. I am completely underconfident. Even if I have access to the right advice, to the right data, to the right information, I am extremely underconfident, hesitant, and reluctant to take a decision. That that is in a way, very similar or analogous to the imposter syndrome, which we hear about and read about in psychology. If I apply this to what is happening around us right now, Deepa, let's talk about the world of artificial intelligence. We are all being plagued and marred by deep fakes, fake news, people coming up with a video which is not authentic. Now at times, because there is so much of a fear around us, there's a fear factor of all this spurious information around us, thanks to artificial intelligence and many other things which are available in the market. We doubt ourselves, and we even start doubting credible sources of information. So that's scary, and that makes life extremely complicated. So who do you trust, and who do you not trust? So difficult play become much more relevant now because of artificial intelligence and all these misuses of technology that I just spoke about. Some of them. How do you overcome them? I think that was your second question, right? So how do you overcome this? The only way of doing that is being very clear and sticking to some dedicated, credible, and trustworthy sources of information. That is one. Secondly, not over doubting yourself before you make a decision. Yeah. So there's a difference between making a knee jerk reaction, and there's a difference in giving a lot of thought and then taking a decision, right? So please think, talk, and then walk your talk. Everybody makes mistakes. So let's not, for the sake of not going wrong, be undecisive or indecisive and not take any action. I think this is one of the good ways of overcoming the imposter bias.
Very true, very true. Rajat, the next question is that, we all have this fear that, should I exit now? Is it the right time to make better returns? So this client wants to understand how can he manage the fear to get the best returns in investing.
Okay, it's an interesting one. And this is not a bias. So the investor is just being aspirational. The investor has big aspirations. The investor who's asking this question, sir or ma'am, you are not a biased investor. This is a genuine thought. Deepa also wants to be the richest woman in Mumbai. There's nothing wrong or she wants her portfolio to be the highest return generating portfolio. There's nothing wrong in aspiring for that. So one is that you should aspire for that. The other is that there also needs to be a realism, right? So I know a lot of investors who have approached us, Deepa, and have said that I want an advice on an investment which will give me double the return with zero risk. Okay. And the time period is not a problem. So I can invest for 6 months, I can invest for 10 years. So these are kind of, very contradictory situations. What you call in English grammar oxymorons, right? They kind of contradict themselves when they're used in the same statement. You cannot have a perfect portfolio. There's no perfect portfolio. There is no highest return generating portfolio. Everything comes at a cost. The coin always has two sides, dear investors. There is risk and there is return, right? You cannot divorce one from the other. So my suggestion to you would be, sir, ma'am, who has asked this question, Deepa, please convey this, that every time you look at a return or a portfolio wealth creation, the number needs to be looked at from a risk lens. Yeah. So that is why we have something called risk adjusted returns. Are you taking $100 of risk to generate $100 of return? $100 return in absolute terms may be great. Your friend maybe have made just $50, and maybe to your credit, you've done the right things and you've got $100, right? So your portfolio momentarily, at the spur of the moment, is the best performing portfolio. But at what cost? At the cost of super high volatility, at the cost of taking extremely unresearched, low researched, and small capitalization companies where the portfolio can double in a day and go half the next. So that is also something which all of us as investors need to consider. The best portfolio is the one where you are taking a balanced risk approach, to get optimal returns. Deepa.
An extension to this question is how to avoid emotional bias while buying or selling stocks. Some PMS fund managers are using IP to avoid emotional bias. What are your views on this, Rajat?
Some fund managers are using IT.
IP.
What
Or
is
else,
that?
you can just take it that, fund managers,
I'll tell you my
they
views.
do
Yeah, yeah.
guide.
So I
Yeah.
don't know what
Yeah.
fund managers are doing right now. To maybe I didn't hear it correctly, but I can tell you.
PMS
And
fund managers, PMS,
okay,
portfolio management service
okay,
fund managers.
okay. Yeah, yeah, fair enough. So let's be honest about this. Every human being has a cognitive and an emotional part, right? So you have the left part of your brain and you have the right part of the brain. Now Deepa will say from psychology you have shifted to biology. So Deepa, next session. Right now we'll stick to behavioral finance. I promise you. Very important to understand that you will behave emotionally, you will have emotional reactions. This is what I said when I said that you behave at times, you behave in a binary manner. It's a very interesting book which I can refer to. Most of you would be aware of that. A lot of you would have already read that book, Thinking Fast and Slow. And this is a book by Daniel Kahneman. I think we lost him last year. He's a great author, and he's written this book about behavioral finance, about how investors react, about a lot of emotional differences. So he's mentioned that, in the initial introduction of his book, he's mentioned that there are times that you need to take fight or flight decisions, and there are times where you don't need to take fight or flight decisions. So both are equally important, Deepa. You can't say that I will never take knee jerk reactions. What if you're crossing the road and there's a heavy vehicle coming from the other way, where the driver has gone off to sleep? That is the time. That's not the time when you will Google and say, okay, let me see, figure out what I'm going to do, to stay alive. That's the time when you're going to take a knee jerk reaction. So that is an emotional response, a response to stimuli, which all of us take, and we are hardwired, and we have it in our DNA. So at times you need to take knee jerk reactions, but in the field of investing, I don't think knee jerk reactions have any space. They have any domicile or residence in the field of investing. When you see markets go down, you should not react in an emotional manner. You talked about portfolio managers. I think gone are the era when portfolio managers were emotionally attached to their companies. Yeah, there is a very strong, and this is to give comfort to the investor who asks this question. There's a very strong layer of scrutiny across portfolio managers and fund houses. One, I'll tell you three levels of security. One, by the organization, because we all work in the fiduciary responsibility of managing your money. Second, by the regulator. So whether it's India, whether it's UK, whether it's Singapore, Japan, US, I think the regulators are extremely, extremely strong, and now they are getting ahead of times. And the third level of security is by you. Investors don't like it when we don't make money for them, Deepa, right? So everybody gets a little nervy when the markets fall and when we are underperforming the benchmark even for a couple of months. So with that level of security, I don't think you have that species of fund managers or portfolio managers who tend to be emotionally attached to stock. Everybody is now moving into real time practical decision making. There's a lot of data which comes in thanks to the positive impact of artificial intelligence. There are quant models which actually use a lot of chatter and a lot of data across the world, combine them and suggest to the fund manager that this is based on the chatter that they have picked up across the world, across forums and different chatter rooms. This is the view on this particular sector or stock. Yeah, so now I think from a professional perspective, portfolio managers find it very difficult to hide behind emotional comfort. Investors, definitely. I may be attached to a stock which was a company which was transferred to be, by an elder or by my father or grandfather, and I may want to hold on to it for ages just because I have an emotional or sentimental value to that.
Thanks, Rajat. What are your views on alternate asset classes like gold, silver? What do you think? Is it
Okay.
a good
Yeah. Yeah.
divestment?
So absolutely, let's come back to that question of asset allocation, Deepa, which you asked me a couple of minutes back. So broadly, so there are hundreds and hundreds of opportunities to invest. But broadly, if you ask me, if you have to divide or categorize asset classes, you would typically look at equity as one, you would look at fixed income or debt as the second one, and you would look at all the others you would want to bucket into alternate assets. So all what is all that? It's real estate, it's commodities, it's gold, it's silver. For some investors, it's crypto, although we have different views on that. Some people don't consider that as an asset class. So I think there is a time and there is a place and there is a need to have all the asset classes in a portfolio. Now, what proportion should you have gold and silver in your portfolio? And what proportion should I have gold and silver on my portfolio is completely individualistic. Yeah, I cannot paint everything with the same brush. So that's a personal call, and that personal call will come with the fact that how much exposure do you have. Now, I think all of us are aware that real estate is a hot asset across the world, not only in India but across the world. And as a matter of default and not as a matter of design, most of us have huge monies and funds and investments by default tied up in real estate. Okay, we forget that because we feel like, okay, that's a second home, that's a third home, right? And that's it's like what I was talking about, mental accounting. So this is the home where I live, this is for my son, this is for my daughter, this is when I retire and when I have to live alone. But ultimately it's your real estate exposure. At that point of time, if someone comes and gives you a real estate investment trust fund, a REIT fund, yeah, you have to consider the fact that already you are over invested and overexposed to one asset class. So gold, silver, very good hedges to inflation, good investments to keep, especially when your financial assets face catastrophe. We saw that happening in the dot-com bubble. We saw that happening in during COVID. We saw that happening during the global financial crisis. Whenever there's a threat of war or the war clouds are looming across any geopolitical region, that's when gold, silver, these kind of commodities come to the rescue. But does it mean that you should allocate 100% or 50% or 40% into that asset class? The answer is no. So always my suggestion would be, please follow a balanced approach when it comes to taking exposure. But to answer your question, the view is positive. We feel that gold and silver are important assets because of various economic and consumption related factors which we are seeing. Gold has its own reasons to do well. Silver also has an industrial use. Let's not forget that. So when it comes to batteries, electronic vehicles, and all that, so silver is used there. So you need to invest, but only to the extent you feel comfortable.
Absolutely. Rajat, two last questions. So
Sure.
this one is on the time horizon. Is there any specific time that or minimum time that you need to stay invested to make the kind of returns that you are expecting?
Let me share this with you. And after all this postgraduate or doctorate in psychology talk, let me take you back to grade 7 mathematics, right? And grade 7 mathematics taught us a very interesting formula called the compound interest formula. Yeah, where everything is a multiplication factor except one. You remember that, Deepa? There's one factor which is raised to the power, which is an exponential factor. Everything else is multiplied or added. That factor is time. So you can increase your principal, you can increase your rate of interest, your money will grow. But if you want your money to grow exponentially, you have to increase the exponential power, which is time. Yeah, P1 plus R raised to the power T. Okay, so that's a very simple way of explaining what I wanted to say. Money compounds, especially when you're investing into high growth assets, equities, and hybrid products. You get interest on interest on interest. Remember the recurring deposits which our parents and grandparents used to do for us when we were minors. We didn't have unit trusts in India at that point of time. So that was also a beautiful example of holding on to time, right? There's a very interesting example which we usually take. Somebody started doing an SIP. For all of you on the call, I'm sure you're familiar with the term SIP if you are related to India and are looking at Indian investments. Systematic investing, where every month you keep investing a small amount into markets. Every month, every quarter, every week, you decide. Now there are people who have started investing with very small amounts, 20 years back, 30 years back, and today they have made houses, they have made huge assets with that small amount of investment. So the only thing which they had with them was time. They started early. So that's the point which I wanted to make. That's the point which I want to drive home, that if you have time on your side, if you want to stay invested for 5 years, 10 years, 15 years, 20 years, the chances of you making money, especially in high growth, high risk assets, are much, much higher and much, much stronger. The only caveat here, which I want to share with all of you, is that at times you also need to review your portfolio. So let's not have the overconfidence bias and say, okay, it's like the old motorcycle ad in India, fill it, shut it, forget it. You also need to service your bike and ride it at times to see how it's going. So please monitor and review your portfolio, either yourself or with the help of your advisors, and then ensure that you don't take short-term, decisions and short-term actions in your portfolio without keeping in mind your faraway goal. Yeah.
Thank you. That's quite the right approach. The last question, many of our clients are impressed with your knowledge. So they're asking, are there any books that you can suggest to them if they want to learn about basics of investments, or, they want to start investing? Is there any author or book that you recommend to them?
Yes, yes. So, for behavioral economics, the topic which is relevant today, Deepa, thanks to you and your initiative, I have already suggested a book which is by Daniel Kahneman, and that book is called Thinking Fast and Slow. It's a very interesting book if you have the passion and flavor for a little bit of psychology on a weekend. And the other book which I can mention to you, I'm forgetting the name of the author. It's called Nudge. That's another good book. That's another way of looking at investor and behavioral finance. On basics of investing, I would typically go back to my Bible and my finance Bible, and that finance Bible is the book by Benjamin Graham, The Intelligent Investor. It talks about value investing. It talks about how do you identify whether a company is worth investing or no. How do you keep yourself dedicated and devoted without a lot of noise and din which is around us, the superflow of information which is always trying to distract and deviate us from our goal. It's a very, very interesting book. The book was written many, many years back. There are, I think, 8 or 9 editions which have come up with updates and prefaces which have been co-authored by a lot of financial gurus and celebrities. That's one book which I can always recommend, and it's an evergreen book. It will never lose its charm.
Thank you. Thank you, Rajat, for your insightful presentation. Thank you to all our customers who have joined us today. For further personalized guidance, please reach out to your HSBC Premier Relationship Manager. This is signing off for the weekend. Have a great weekend, and we'll see you next month. Thank you.
Bye bye. It was a pleasure. Thank you. Good evening.
Thank you.